There's no shortage of bad news for Disney stock, whether or not it's writer strike, management turnover, dying linear networks, tough streaming competition. Not surprising to see the stock down around 5% year to date, continuing to make what looks like new lows for the year. And then looking at over the last 5 years, stocks down around 25%, a really terrible ride for investors. This is actually part of the reason why I'm starting to like Disney stock. I did a prior video on this, and I'm reiterating it, with this video going through their latest earnings to talk about, there's all these negative headlines, and I think it's currently being baked into the valuation because, as I talk about in this video, towards the end of this video, if you were to strip out just their core parks experience, selling their merchandise business, and you ignore everything else, their dying linear networks, their unprofitable direct to consumer, their, ESPN, how's that going to shake out? You look at all these other products, you ignore all that. Just look at parks and experience, and that alone can justify Disney's current price, maybe even suggest 100% upside. We're going to talk about that in just a second. If they're able to improve and show that direct-to-consumer is profitable, much like Netflix is, then you're talking about potentially closer to 100 to 200% upside potential for Disney stock, depending on their execution. If you enjoy educational investment videos, please make a point of hitting that thumbs up, hit that subscribe button. You're watching Unrivaled Investing, so let's dive in to understand Disney's latest results. Looking at their third quarter results, you see revenue still growing, which is what I like to see. You see their segment profitability around break even. Then I see that their pre-tax income has just absolutely collapsed from 2.1 billion to a loss this year. I'm going, what is going on? So I check in with AI Ticker Chat, which leverages artificial intelligence to help me see, quickly getting an assessment of what's going on. First month is free. And so I see quickly that there's a restructuring and impairment charge for 2.7 billion. I actually click on that. It pulls it up and explains that this charge is a content impairment charge that management talks about. We had to take a $2.4 billion impairment charge related to license agreements for the right to use content, primarily for the company's direct-to-consumer platforms. This is a key indication that their investments in their direct-to-consumer platform haven't been going as well as they wanted. The fact that they've been having to do a huge write-off. Now, this isn't a cash impact in this quarter, but it is saying that their prior investments aren't panning out the way they expected, not delivering the growth in direct-to-consumer that they previously expected. Now, let's go back to this parks and experiences business, which is just amazing. You're talking about the Disneyland resorts and parks, and you're looking at revenue growth of 13% year over year in the most recent quarter. It's better than that on a year-to-date perspective. Operating profitability up around 11%. Their domestic parks, so think about North America, was, posted growth again, which is, investors like to see. Their profitability did take a little bit of a hit. This was because of this huge mega park that they invest. It's a mega hotel, I should say. Their Star Wars Galactic Star Cruiser, which just didn't have the volume, to meet the exorbitant pricing that they had for it. And so they're shuttering that. So that's part of the reason why you're seeing this lower profitability for domestics, but you're seeing huge surge in their international parks from a loss last year to profitability this year. So you are seeing a nice continued growth in operating profitability and revenue in their parks business. So this is what investors like to see. The challenge is their media and entertainment business, predominantly their linear networks, continues to come under pressure. You see $7.2 billion in revenue last year, down to $6.7 billion a year. I mean, this is another example of cord cutting. You're seeing their profitability drop. And as their profit drops, it's going to be tough to balance out the losses with their direct-to-consumer business, and that's what you've seen. But they have improved. Their direct-to-consumer losses have improved significantly from over $1 billion in the quarter last year to $500 million this year. The question is, can they get to profit? Will their direct-to-consumer business get to profit? Management thinks they're going to be able to do it by the end of next year, but you can see how their direct-to-consumer business has sort of changed over time. Yellow is the programming and production costs. The green here is sales, general, and admin. Then there's other expenses. So you can see that it's pretty stable over time. Management is going to have to figure out ways, and management talked about this several times during this call, to sort of manage their costs to get better returns on their investments with direct to consumer, particularly as they think, okay, how can we create effectively this compelling content at lower cost? I actually think if they rapidly embrace the revolutions that we're seeing with various different artificial intelligence technologies, where it's becoming so much cheaper to create new imagery and could create new videos, that they could lower their cost on, on these productions, on these key shows. The question is, does that actually result in more competition for them over time as well? So that way, really, the winners could be someone like YouTube, where you have a bunch of low cost creators making movies, making TV shows that then get uploaded to something like YouTube, versus Disney. But I think they could embrace cost cutting with technological innovation, and that could certainly help in terms of generating a profit. I mean, clearly they're raising prices. That's one of their initiatives. Another key aspect of why Disney stock is coming under pressure is because a lot of folks had previously thought, oh, Disney's going to be the Netflix killer with streaming. That's what a lot of folks previously thought, years ago, when they were looking at Netflix and looking at its lofty valuation and growth. The reality is, it is a lot tougher to win in streaming than folks thought. It is a very tough business, streaming. Disney's domestic subscribers actually declined by 300,000 in the most recent quarter as they raised pricing. However, this was offset by continued growth of over 1 million subscribers, 1.1 million subscribers around the world. So net, still a growing business. They did benefit from higher prices. So they are trying to say, hey, look, we're going to keep raising prices, on users, but it's going to be tough. Management does expect, their next quarter to, show a favorable development in terms of, looking at continued expansion. So in their fourth quarter, they're expecting to show continued growth. And so this recent decline, this quarter over quarter decline, they're expecting to reverse, with Disney. So the question is, okay, so where does Disney go from here, given these challenges, given these uncertainties? First, in full disclosure, this is not financial advice. And if you're looking to take charge of your investment journey with compelling ideas, market insights, and an exclusive Discord community available for annual subscribers, I personally will let you in. You just say hi after you sign up. Come check out unrivaledinvesting.com. We also have educational materials if you're interested in, learning how to read financial statements or value a stock. I made materials based on what I would have wanted to know when I first started working on Wall Street. And so looking at Disney, thinking about where do they go in the years ahead, they have an incredible lineup of both new TV shows, new movies, as well as upcoming parks and experiences. You have World of Frozen opening up at the Hong Kong Disneyland Resort, Zootopia themed land. Their cruise lines are absolutely crushing it, 98% booked occupancy for the fourth quarter. They expect to open new cruises, in the coming years to meet this really strong demand. So I look at their parks, experiences, and products. So far, this business is crushing it, growing high teens %, closer to 30% profit margins. In my assumptions, I'm assuming maybe they're running a little hot right now. So I go maybe 25 to 30% margins over time. Maybe that's overly conservative, because they're closer to 30% profit margins right now. And I actually fully penalize this division by saying, let's put all of Disney's interest expense, so all of the debt that Disney has, let's apply it to the Parks and Experiences division. Let's pretend that almost all their other segments don't exist. That's what I'm trying to do here with Parks and Experiences, saying, yeah, they have around $2 billion in annual interest expense. This means that their core business, this Parks and Experiences business, could generate around $5 billion in profit, maybe around $6 billion in after-tax profit per year. So maybe it's trading relative to its current market cap of around 25 to 30 times earnings. If you assume this business continues to grow in the years ahead, which I think it will, I mean, there's all the signs indicate that they continue to do really well, apply some sort of multiple. I think it should warrant a premium multiple of, let's say, 20 to 30 times earnings in the years ahead. And you can effectively say, hey, maybe this is break even over the next 5 years to maybe 100% upside alone just from this segment. Now, keep in mind, this is a hypothetical framework. It depends on their execution. It depends on sentiment. It depends on market forces. Is there a recession that really, hurts attendance at the theme parks and people buying food at the theme parks and buying, Disney princess dresses, these types of things. This is a key division that creates significant value for Disney. And I think a lot of folks are just focusing on direct to consumer and the struggles they've had there and the dying linear networks and saying, oh my goodness, Disney's, not going to be able to turn it around. I'm showing clearly here that Disney experiences, products, parks, that alone is worth a lot relative to Disney, even relative to their current market cap. If you think direct to consumer business, I'm not including linear. I'm saying let's assume linear goes to zero. Trying to be conservative again, just think about their direct-to-consumer business. If you think that they can have profit margins at a significant discount to Netflix, Netflix thinks they can do 20 to 30% over time. I'm assuming they get to 15%. Keep in mind, they're currently unprofitable. But let's assume that they get to, teens rate profit margin in the future, and they're able to still keep growing at a high single digit, low teens rate over the next 5 years. Assuming a market multiple around 20 times, then Disney's direct-to-consumer business could add several tens of billions of dollars to their current valuation. Looking at adding these different pieces, the parks and experiences plus direct-to-consumer. I think at the end of next year, if management shows that they're serious and that they can get this to both growth and break even or better profitability, then I think Wall Street starts waking up to the real potential here with Disney stock. A few three key takeaways I think investors should consider. One of which is that I think a lot of the valuation is including a lot of these negative developments. And that you're going to need to see continued execution. You're going to need to see hit movies, products people like Avatar: Way of the Water, which is done very well for them. So you need to make sure that you're delivering products that resonate with consumers. So that's super important. They need to be able to keep doing that. But on the flip side, if there's an economic cycle that starts to turn lower, and a lot of people have expected it, I personally expected to see a recession. If you see a recession, we've had dramatically, high change in interest rates from close to zero to nearly 5% on cash. I personally keep my cash at Interactive Brokers. See the link below. I think that change in interest rates is going to impact the economy at some point. It certainly hasn't seen it now. I mean, Disney's cruise ships are at 98% occupancy. People are loving this economy. People are very eager to go spend their money with the various different Disney theme parks. I mean, they talk about how they're doing even better than, 20% plus better than where they were in 2019. So through COVID, they've continued to grow. So that's important to recognize. So if there is a recession though, then you have this real risk of, hey, wait a second, this theme parks business, that's going to take a hit. And they're direct to consumer, maybe that takes a hit as well. So in that scenario, then things start getting a little, concerning. Now, long term, I still think you have this thesis of, significant upside, but one should be aware that this is still a company that is heavily dependent on the consumer, how the economy is doing. Another key point that you need to consider is direct to consumer, that I think, and as I've alluded to, they're currently unprofitable. If they get to what management thinks of closer to break even or profitable by the end of next year, I think Wall Street starts waking up to it and saying, hey, this is a turnaround story. Their economics are improving. You're no longer going to see these huge write-offs like this $2.4 billion charge that I called out at the beginning of this video of saying, hey, we made all these investments and it didn't work out for the direct consumer part. So that's really critical, to see continued execution in the right direction with the direct to consumer, both growth in terms of subscribers, growth in terms of revenue, growth in terms of pricing, and improving profitability. You need to see all of that for investors to get more excited about Disney, improving direct to consumer. And that includes the uncertainty with ESPN. How do you make this transition from ESPN, historically linear, to direct to consumer offerings, streaming offerings for all their various different flagship channels? So that is something, investors are going to need to see across all of ESPN's assets. And they're making steps to do that, but we'll see how that plays out. I think a third, key development that investors might see in the years ahead is this very strong possibility you see either a large value investor get involved. It would not surprise me to see someone like Warren Buffett's Berkshire Hathaway get involved. He owned Disney stock decades and decades ago. It wouldn't surprise me to see a strategic acquirer like Apple come in and say, hey, we're already making these billions of dollars investments in content. Why not figure out some sort of partnership? Now, they actually were asked this very question on the most recent call, and management pretty much said, hey, we can't comment on it. In B, you have to check the regulatory environment, to make sure, the current, politicians wouldn't just say, no way, we're going to let a deal go through. But I don't really think that Disney being acquired by, let's say, Apple would really hurt the consumer much, or Disney being acquired by Google. Even if it's a low probability event, I don't think that's being priced into the stock at all right now. So I think you can either get, strategic value investors start buying huge stakes in the company. That would not surprise me at all, just given the valuation framework that I've laid out, or you see some sort of takeover initiative by a mega cap. Wouldn't surprise me. I don't put that as a 50% probability. I just think it's a low probability, but it's also a probability that's transformative for the stock, and that I don't think is priced in at all. Looking at the current valuation, looking at Disney overall, I think Disney has the potential, as I've already mentioned, to outperform the broad US indices over the next 5 years, taking a multi-year perspective. If you enjoyed this educational video, please make a point of hitting that thumbs up, hit that subscribe button, and for more exclusive content, check out unrivaledinvesting.com. Thanks so much for tuning in.